Let's get some perspective then on this market with Pankaj Tibrewal, co-founder and CIO at Ikigai Asset Manager. Thanks very much, Pankaj. Always a pleasure to have you on our shows. So yeah, I think this market has defied all odds. It's been defying gravity. It's charging higher. But I think the question that most people are now grappling with, how do you put fresh money to work? Whatever's already invested, people are enjoying and, going ahead with the ride. But buying a fresh one wonders if you should wait for that dip, what to do, what not to do. And the dips rarely come. Your thoughts on how one should be approaching things from here on?
Good morning, Surabhi. Yes, absolutely, you are right. Post the election day fall, we have seen markets make a very strong comeback and cross the all-time highs. However, at this stage, I think it's very important for all of us not to get carried away because mistakes are made at the top of the market. And we believe that there is froth in many pockets. We were just looking at some of the delivery data of some of the best performing stocks across the board. And it's startling to see that in many stocks, the last 6 months cash delivery volumes exceed the free float market cap. And this time, the entire rally is driven by non-institutional investors. And whichever pockets and institutional investors I speak to, global or local, I think everybody agrees to the fact that there are many pockets where you can't justify valuations. And it's basically moving because of non-institutional investors. And I think markets are at a big high. I think today we should take this opportunity to talk about looking into the history, what could be the risk at this stage in the market. And at this stage, I think it's very important for every investor to have a clear view on the risk in the portfolio, as well as in the stocks they are carrying. Otherwise, mistakes are made at the top. I think a few things which you need to understand that today the contribution of mid and small caps as a percentage to overall market capitalization stands at about 36%. And their profit contribution is about 25%. So the divergence is clearly there between the profit as well as the market capitalization contribution. The second point we need to understand, Sophie, is that today the investors are expecting a very strong earnings growth. When we do a reverse DCF for a lot of companies, we believe that market is expecting unreasonable earnings CAGR for the next 15, 20 years, which looks difficult from our side. Third, when we look at and dissect the fourth quarter earnings, summary of NSE 500 companies, there are 87 companies which are banking and financial companies. There are 413 non-banking and financial companies. And the entire group last quarter was carried away, was done by banking and financial services, which grew at 24%. And the non-banking and financial services, which is largely the larger part of India, grew just at 7.5%, 8%. So we believe that the earnings growth after a long time is starting to slow down. Last year, NSE 500 companies grew at 30% from a FY23 base. I think this number could be about 14, 15% this year. So I think we need to take cognizance that earnings have started to slow down in the broader markets. And I think valuations are not factoring in that. Going into the history, there are 4 kinds of risks which generally comes through. The first is through macroeconomic instability, which we saw in the Asian crisis, which we saw in tapering tantrum. The second is the leverage part on the households, government, corporates. The third is the political and economic instability. And the fourth is the man-made or natural disasters, which we saw in COVID. The first 3 obviously are looking good for India. There's no problem. Fourth, nobody can call out. So I think risk today, nobody can foresee today. But from a valuation perspective, government policies, taxation, the murmurs which are going around on capital gains, I think something could disrupt, and valuations are something which we should not ignore at the current juncture today.
Okay, so we shouldn't ignore valuations at the current juncture. Got that. Pankaj, hi, good morning and good to see you in after a while. We have a big event upon us, which is the union budget, right? Do you think there's anything in the budget that can be market moving? What is your ask from the finance minister this time around? Because considering that they've come back to power now for the third time in a row, I'm sure there's some aces up their sleeve. But from a market standpoint, what are you expecting?
Good morning, Sonia. I think just in a month's time, budget will be around the corner. Look at the data. In the last 4 to 5 years, the spend on rural has been absolutely flat, which is about 4 lakh crores. The direct expenditure of central government on rural schemes has been flat at about 4 lakh crores. Looking into the election verdict which came, and we analyzed the data very carefully, the government lost about 60 seats in the rural areas. And that's a large number. Our sense is that probably a part of that expenditure, which has been flat for the last 4-5 years, will see an uptick. And on the same breath, the capex expenditure, which was at about 3.5 lakh crores, is expected to be 11 lakh crores. So I'm not saying that the capex expenditure would see a dip, but it could see a moderation. And a part of that capex expenditure could be shifted to rural. And I think on that side, consumption could see a comeback. Our channel checks across last 1 to 2 months have been suggesting that there's an uptick in the rural consumption space already. And though companies are not very confident whether it will be sustainable, but our channel checks across the board is suggesting there has been an uptick on the rural side. And I think that's going to continue. Also, we believe that the consumer durable space probably can make a comeback. We have seen very strong summer, and that's likely to sustain going forward as well.
Okay, so you're positive on both rural names as well as urban discretionary consumer durables names as well. You did allude to valuations being stretched in a lot of parts of the market. What are your thoughts on relative valuations in the consumer space right now? Is there a lot of upside? How do you play this? Do you play this via the staples? Or do you play it by some new age themes? How do you go about this?
So obviously valuations on a relative basis, are looking not so great across the sectors, except banking, maybe pharma, maybe some of the consumer rural discretionary names and so on and so forth. But one thing which is a very interesting data point, over the last decade, the consumption in India has gone through a massive change. The composition of consumption today, which includes smartphones, wearables, OTT, mobile data, is now about 6.5 lakh crores spent, which was not there a decade back. So when we talk about consumption, we also need to take into account these categories which were non-existent, a decade back. And mind you, this is not a small number. It's twice the size of the car market in India and 6 times the size of the two-wheeler market in India. And hence, we need to see consumption on a holistic basis. I believe that there has been a rise, and there will be some shift from these categories to the main staples and some of the urban discretionary names, especially the consumer discretionary names. We believe that the non-linearity in margins could be very high. For example, in consumer durables, the profit pool is at a decadal low. And I think that will limit competition going forward. And many players, we would see non-linearity in margins. Margins are at rock bottom today. And once top line starts growing, margins will automatically see a comeback.
Okay, I wanted to come back to the first point that you were making about how you're a bit bearish on the market. You think earnings could slow down a bit. So how are you positioning yourself? Which are the sectors that you would be avoiding now because of steep valuations? And which are the sectors that you like? I mean, you spoke about how consumer durables may make a comeback, but overall, how are you positioning yourself?
So, Sonia, I think there are 3-4 sectors where we believe that there's a lot of margin of safety. The first one is private sector financials. We believe that they have been continuously growing, delivering good numbers. And there is reasonable margin of safety when we look at their franchise and when we look at the growth potential ahead. The second is pharma. I believe that pharma, both from domestic and US generic side, is offering decent margin of safety in terms of valuation, and on a PEG basis, which is for the growth per unit of growth, what price you are paying, seems to be reasonable. The third is the entire consumer pack. I think we need to be careful on that side in terms of many names still at punchy valuations, but there seems to be growth returning back into that sector. And that's where incremental, opportunity lies. And last but not the least, I think some of the industrial names which are linked to private capex. Having said that, what to avoid? I think clearly the list is loud and clear. Some names where there's low free float, names where there's business to government businesses, but factoring in huge expectations and small change in policy can derail them in terms of overall growth trajectory. And making sure that we understand what we are paying for the next 10, 15 years from a stock valuation. So the no-go list is very, very clear, and we need to avoid them and make sure that over the next 12 to 18 months, we navigate this market carefully. I think the important point today is not to focus too much on upside immediately. I think the focus should be preservation of capital over the next 12 to 18 months as we move ahead.
All right, preservation of capital over the next 12 to 18 months by being in places that offer margin of safety. Pankaj, in light of all of this, there are always some new themes that are playing out in the market. Is there anything that you found which you think is interesting and this is a theme that could maybe generate some alpha over the near future?
Absolutely. The consumption basket, which has been new completely, the 6.5 lakh crores, which includes so many other new categories, probably will see itself getting listed over the next few years. And I think that will be an interesting space because consumer preferences have been changing in terms of spend. And any company riding that will be an important portion. Second is the most important is the premiumization, which has been growing in India. And I think companies offering on that side may come for listing over the next 18, 24 months. And I think what is interesting in this market is that good quality companies are getting listed with good business models. And I think that will increase the market breadth as you move forward. And the third is on the tech side. Many of the companies are non-listed today, and some have got very strong business models. We are eagerly waiting for some of them to get listed as you move ahead.
We have the Stanley IPO listing today. I don't know what you think of it. Then there's Hyundai, some of the bigger ones that we are talking about. There's Ola Electric, a lot of the others. Could you name some of the IPOs that you are eyeing this in the next 12 to 18 months?
I won't go stock specific, but generally this will be the focus where we would deploy incremental capital on the new listing. Also, I think that there are many names in the listed space also, which are offering decent opportunity if you take a 5-year, 10-year view on them, especially on the premiumization theme.
Okay, Pankaj, thanks a lot for joining in and have a great day, have a good weekend. Well, that's the word coming in on the market.